pleasure to be here today to interview John Heilemann. This is going to be a great conversation because Fred and I are going to take turns.
Are there any subjects that are off limits?
Yeah.
When we interview you?
Oh, God, you're so boring. Jesus. All right, so gentlemen, it's great to have you here today. First of all, I want to, if anybody who doesn't know this is an unprecedented, first-in-a-lifetime moment. Two of the giants, not physically because you're both sort of dwarves, but in terms of stature, two of the giants of venture capital.
Intellect.
On the left, John Doerr, rapidly aging but still legendary figure in the Silicon Valley investment world. Fred Wilson, the youngish upstart.
And
from
on
Union
your
Square
far
Ventures.
right, the balding John
Yes,
Heilemann.
no, entirely bald, I would say. I think we're going to talk about 20 minutes, and then we're going to take some questions from the audience. I'm going to try at the beginning, because I know, first of all, that you guys don't know each other well, and to the extent that you know each other, you don't like each other very much. I'm going to try to keep peace for the first part of the thing, and then I'm going to try to incite the great VC smackdown. So let's start by just trying to get a sense of where we are right now in terms of the investment environment. Fred, you wrote, and I'm going to start with you just because you're closer in terms of the seating arrangement. You wrote a post the other day in which you talked about the environment in the startup community right now. You used a bunch of phrases that some people decoded as saying that you were saying there was a bubble at hand, but you didn't actually say that. You did say that there was storm clouds on the horizon, there was some overexuberance, and you referred to unnatural acts that you've seen recently among investors and entrepreneurs. This is a PG audience, so if you could stay away from describing unnatural acts in too much detail, I'd like you to talk a little bit about that post and what you see right now in terms of where we are in terms of frothiness in the environment.
Well, in certain sectors of internet investing in particular, this has nothing to do with energy investing or life sciences investing. Certain areas of the internet, which this is the Web 2 conference, so this kind of stuff, there's some crazy things going on. And it's getting overheated. People are getting crazy. They're showing up to their first meetings with term sheets. There's some rules of thumb that sort of exist in the business. A company that's 3 people just getting started should be worth less than $5 million. A company that, maybe has built a product but, barely released it should be worth less than $10 million. I mean, these sort of time-tested rules, and we're way beyond those prices in the early stage market, 2-3-person teams getting 30, 40, $50 million valuations. I think that's not right.
John, you see that same, you guys obviously live on separate coasts. Do you see that same phenomenon out here in the Valley as much as Fred's seeing it out in New York?
I think what Fred's describing about valuations for sure is right. Where I think we are is at a really unusual and exciting time, and that's at the start of, you've heard me say this, John, we're not even at the startup. We're right in the middle of a huge third wave from the perspective that I see. And the entrepreneurs are better, the ideas are better, the markets are larger. And so in the first wave, there was this PC internet thing, and that enabled all of what we have. That was in the 80s. And then around 95, you did a series on it. This 22-year-old kid, Mark Andreessen, came out to the Valley, and he built a web browser that I think was the start of, I guess, what we'd call here Web 1.0. But now the combination of smartphones, of social graphs, in the sort of friction-free way that businesses can grow with very little capital, has made the business of building what Ben Gordon likes to call an internet treasure a lot more exciting, a lot more challenging, and makes this time exciting. I prefer to think of these bubbles as booms, and in every boom, I think booms are good. Booms lead to overinvestment. Booms lead to full employment. Booms lead to lots of innovation. There was a boom when they started the railroads. We're in another bubble or boom, and it's an exciting time.
I don't think that's what Fred's saying, though. Fred, you sounded a little bit pessimistic. Your view is that there's a distinction between a boom and a bubble, and it sounded like what you were saying is that this is not going to end well. I think that's explicitly what you said.
Well, first of all, I think what John said about we need to have periods of frothiness is absolutely right. My friend Tom Evslin says, nothing great is ever created without irrational exuberance. And so I think that's totally accurate. And this frothy time will finance a lot of great ideas that will become great companies. But we do need to focus as much of that capital onto truly new and different ideas and not a lot of sort of retread, Me Too kinds of things. And I see a lot of that happening.
Let me stay with the environment just for a second. There's begun a conventional wisdom for the last X number of years that the IPO opportunity has sort of closed down. Talking to some of your associates at Kleiner the other day, John, I said, this is a conventional wisdom, is that it's impossible to take a company public now, and they said, well, it's not impossible for us here at Kleiner Perkins. I'm curious about, Bill Gurley just posted something about this yesterday, I think, saying that actually the IPO market is coming back, even though everyone's still very pessimistic about it. It's actually coming back pretty strongly. It just isn't coming back right now in Silicon Valley. So talk about that and whether what the new reality of getting public is right now.
Well, I think the IPO window's open, and we may be in one of these rare periods of normalcy where good companies can go public and bad ones cannot. But there's any number of really great companies who could go public right now and who choose not to. So,
well, that's the latter point, though, I think that's interesting. Bill talked about this in his post. If you haven't read Bill's post, it's at abovethecrowd.com, Bill's blog, and it's really a great post. But what Bill says is that there's a conventional wisdom in Silicon Valley right now that if you have a great company, you don't have to go public. And he points to Netflix and Salesforce and Amazon and the entrepreneurs behind those companies as proving that being public is an advantage. If you have really big ideas and big ambitions, you should be public. And I thought it was very well said. You don't see Facebook going public. You don't see Zynga going public. Not to say that either of them won't go public, but they haven't yet. They both could. So there is clearly a reticence about going public, and I think those aren't the only two companies. There's lots of companies that could be going public that aren't going public. I think some of it is that there's liquidity now available through the secondary markets for the early investors and the early founders, some of whom are no longer involved. That pent-up demand is not forcing the hand of the CEO and the board to get the company public, and so that's relieved some of the pressure.
But you've written about this before and have said that your view is that you don't actually think that more than 10% of your portfolio companies should go public.
Well, what John said is exactly right. Only the great companies should go public. There's plenty of good companies that are funded in the venture business that shouldn't be public companies for whatever reason. They don't have defensible enough businesses. They don't have big enough businesses. They can't grow for a decade or two. And so they should get sold. And I think the big mistake we as venture capitalists made in the late 90s is we thought that a third of our portfolio or 40% of our portfolio should be going public, and I just don't think that's the right number.
The interesting thing one of the interesting things in that post was that it said that Bill noted that the stats show that in the last 2 years there have been 42 companies, high-tech, venture-backed companies that have gone public. Only 11 of those have been Silicon Valley companies, which is pretty surprising. You, John, have always made part of the whole Kleiner thesis has always been, to be Silicon Valley-based and to not make big investments in companies outside the Valley for a lot of good reasons, which we can talk about. Do you think that the balance is shifting now in terms of where the center of the entrepreneurial action is in this new environment? Is Silicon Valley finally, is the thing happening to Silicon Valley that people long predicted, which is that it's losing its centrality in the entrepreneurial information technology area?
Well, I believe that the center is still Silicon Valley, or somewhere between Silicon Valley and San Francisco, or it's bimodal. I'd say those are the two hotspots, if you will. But it's also very true that there's lots of innovation happening around the country. At least that's where my focus is, in addition to some of China. So if your question is some of it shifting away from Silicon Valley? I think the answer is absolutely.
Well, some of it's shifting to New York, right, Fred? And this has been kind of a debate that's broken out occasionally over the last couple of years about whether New York is becoming a rival to the West Coast in terms of germinating, especially certain kinds of web startups. Make the case for why you prefer, not just why you do well as an investor in New York, but why you would actually rather be in New York investing than be out here, because I know you believe that.
Well, what I consider to be software-driven businesses where the essential ingredient is a bunch of software engineers building code that runs on top of the internet stack and is deployed in a web browser or a mobile device, those businesses, I think if you look at the statistics, they can and are getting created much more evenly than some of the classic core tech stuff that Silicon Valley has always been, had a stranglehold on, and frankly still does. In New York, what you have is you have lots of super talented people, very entrepreneurial people, who have slightly different worlds they exist in: the fashion world, the finance world, the marketing world, the advertising world, entertainment, media, et cetera, and all those worlds are colliding with the internet, and so lots of interesting software-based internet mobile businesses are getting created there, and I think it's a real happening. It really is going on. And the other thing is that our firm has been well situated relative to other parts of the country to make those investments. There isn't a lot of venture capital in New York. There's starting to become more, but we've had the advantage of being one of the few people looking to make those kinds of investments over the past 6 or 7 years, and so it's been a good environment for us.
You were going to say something?
I just was
You had your hand up?
I did. Yes, please. Over here, Professor. The great platforms on which you're going to build really rapidly scaling businesses are mostly in the Valley. If I want to do something mobile, I want to work with Android or I want to work with Apple. If I'm going to do something that's on a social graph, I want to work with Facebook, or I want to work with Twitter maybe for feeds. So I think this remains a very, very good place to get a lot of engineering talent and get connections to those platform providers and get big fast. The 4 companies driving the internet today, I think we probably all agree, are Amazon, Google, Facebook, and Apple. And there's tremendous opportunity in and around those platforms.
I want to come back to all of those companies, especially since Fred has said some kind of controversial things about, I think, almost all of them in the last few months. But let me ask you one more question about the financing environment. There's a lot of talk about a super angel bubble, or a hyper angel bubble, or a mega angel bubble out here. You guys have both been, respectively, in the venture capital business for a pretty long time. John, you a little longer than Fred. How is that? How do you see that phenomenon, and how is it changing the way that you guys do business in the traditional venture model?
So my 2 favorite angels are, I'll cause some controversy with this, but they're Andy Bechtolsheim and Ram Shriram. I say that to say that I think we've had angels, which are individual investors who are magnets for entrepreneurs for quite a long time. What's going on is there's more of everything. It costs less to start a company. There are more Ram Shrirams and Andy Bechtolsheims who will refer to you as Sun or a Google. And there's more sort of what I'll call classic venture capital. There's never been a better time than now to start a company. As I said before, the entrepreneurs are better than ever before. It's really easy to get capital to start a business. I think the challenge is to build a great business, or even beyond that, to build a kind of treasure that's going to change people's lives. And this is just a great time to do that.
Fred, glut of angel money, bad thing, good thing, make your business harder, make your life better?
It's a good thing for everybody other than the angels.
Right. Why?
Well, because they now can't get into deals they used to get into. There's too much money, and it used to be that when you syndicate an angel deal, everybody could get in because everybody's writing a $50,000 check or a $100,000 check. If it's $1 million round, they could all get in. Now there's so many of them that they can't get in. And I think all of the hullabaloo about this is just related to that one thing, which is they can't get into the deals they want to anymore. And so now sharp elbows, and people are starting to, get, protective of their deals, which never used to happen. So it's not good for the angels. It's great for the entrepreneurs. It's great for the traditional venture capitalists because more companies are getting started, more opportunity for us to invest. It's great for the ecosystem. It's great for all the platforms. It's great for everything but the angels. And by the way, it's not bad for the very best angels. If you're Andy or Ram or Ron Conway, I mean, there's a few people who still can get into the deals they want to get into, so it's not bad for them. But it's bad for everybody else that's doing angel investing.
The other thing I should add is I think folks that you might think of as traditional venture capital funds, whether they're trying to effectively invest over some period of time $100 million or hundreds of millions of dollars, they are, when they see a great opportunity, they're backing that entrepreneur on the spot. Reid Hoffman's doing this over at Greylock, somebody I admire a lot. My partners, Kleiner Perkins, are doing that. So I think it's not about the money. And don't get me wrong, money really matters, and valuations matter. What I'm mindful of is what Mark Pincus says about this to entrepreneurs. He says, you ought not to be trying to maximize what the valuation is. You ought to be maximizing your control. If you want to be CEO, try to stay CEO. Find somebody who can help you succeed with that, and be really clear about what it is that you're trying to accomplish.
Let me ask you, John. There I think was a pretty broad perception for a period of time that Kleiner had sort of lost interest in the web, and that you guys had decided that green tech was more important, that you were off chasing other important dreams, but you were not really a web-focused venture firm anymore. That perception has changed, partly because of started with the I Fund and now with the S Fund. I want you to talk about, I know the S Fund is a new thing, and you've been public about it in the last couple months, but it'd be worth at least having the discussion now. Tell us about the investment thesis behind the S Fund.
So I'll touch on both the I Fund and the S Fund, but try not to be commercial about either of the two. Right. And we launched the I Fund before there was an app store, actually before there were APIs for the iPhone. And it's because, Bill Joy held out these smartphones and said, this is the next PC. And it's not an incremental Web 2.0, inconsequential, socially networked, anonymous teen dating site where you can get laid on the avenue while you're walking down Palm Drive at Stanford. This is really profound. This is very important. And Bill's amazingly clairvoyant. He persuaded us all of that. And so we put together this fund, $100 million. People thought we were crazy. And I think they'd still think we were crazy, except for NG Moco having been bought for $400 million 18 months after we invested. And we paid back the whole fund. So this mobile thing isn't over. As Mary Meeker said, it's a monster market trend. It's just getting started. And that 2008, I guess it was, that we formed that fund. And then iPad came out, and that looked also to be controversial, but really big, so we doubled that. The S Fund, which is the point of your question, was honestly born out of the amazing, humbling growth that we saw at Zynga. Zynga is the largest, most rapidly growing, most profitable company with the most happy customers that Kleiner's ever invested in. I'll say it again. Largest, most rapidly growing, most profitable, with the most happy customers that we've ever seen over its not so short, but still modest life. And what it said is that this friction-free environment where you can have Facebook for distribution allows you to rethink and reimagine every function, every service in this new networked economy. And entrepreneurs are doing just that. So the idea of the S Fund was to raise our hand and say we're very much in the business of looking for, wanting to back, accelerate the success of entrepreneurs who want to do that. We had Facebook and Zynga, which is the role model, and Amazon as strategic partners for the fund, and some others. And we've gotten, it's less than a month old, 600 proposals. And, we have 6 of them we're ready to invest in, which is just remarkable. So take note. This is a really special moment in time for people to build on these platforms.
So when you guys came out and announced the S Fund, there were a couple different kinds of reactions, and actually I'd like you to comment on the reactions to that fund. One reaction was, hey, that's a really great idea if it was 2006. that Kleiner's, good of them to be jumping on this bandwagon. They're awfully late. And another way to say that is, hey, there's already an S fund. It's called Union Square Ventures. What do you think? Are those guys just really late to this market that you've been playing in, Fred, pretty actively for the past 2 or 3 or 4 years?
Well, first of all, they're not late to the market. I mean, Kleiner is an investor with us in Zynga. So it's not like they didn't understand this opportunity a while ago. I think they just decided to double down on the opportunity in a very big way with some strategic partners. So I don't think I don't think it's a late to the party issue. And what's interesting to me about the I fund and the S fund is the intersection of those two funds, where I think all the interesting stuff is happening. It's the combination of mobile and social. John said it earlier. It's the computer in your pocket combined with the social graph that is presenting all these interesting opportunities. And so Kleiner has a model going back to the Java fund of identifying themes and creating fund vehicles to go after that. That's one way to go about doing it. And we don't do it that way, but we share their strategy.
Let me stay with you for a second, just because of some of the companies John mentioned before, some of which you've had some strong points of view on. I'd like to go through those with you.
Sure.
Talk about them and see what Dr. Doerr has to say about them.
Right.
Let's start with. I'll give you 3 of them in a row, and we can go through each. The first, Apple is evil.
Well, so John talked about the free-flowing architecture of these platforms. It doesn't exist on Apple. You're a developer, you put your app up on Apple. It takes a week to 2 weeks to get into the store. You can't post updates. There's no auto-update functionality. Writing an app for the Apple device is not like writing an app for the web, and it's not like writing an app for an Android. Android is the free-flowing platform for the web. Android will be the dominant mobile platform, not Apple, because it's a closed environment. It's just not the right architecture.
What do you have to say about that, Mr. iFund?
Well, Apple's done an amazing thing for software developers, right? It broke through the gated walls of the telecommunications carriers. You no longer have to apply to one of the wireless carriers to have your application on their deck. It's written over $1 billion in checks to innovators and software developers. It provided them distribution, immediate access to an enormously large market for these new kinds of services. And I think we ought to give Apple an enormous amount of credit for that.
Fred just said
we give them credit for it, but they've created the cable system, okay? It's a closed system. Let's give Tim Berners-Lee credit for creating the World Wide Web. What Apple has created is not the World Wide Web. It's not even close to the World Wide Web. We just have to be honest about that.
Well, and what Fred also just said a second ago is that Android would be the dominant platform and not Apple. And as a Google investor and board member, I'm curious, John, what your thought is about that particular observation.
Well, the market share numbers, everybody in this room knows, shows that Android has very rapidly shipped a lot of units. I think Apple is providing a really curated set of web experiences, and I consider it to be very successful. Android is growing explosively, and I think there's terrific opportunity there as well.
Fred, my second one of your comments of late has been that Facebook is a photo sharing site with some chat attached. Since Mark is sitting in back and about to come out, I thought we might want to talk about that a little bit.
I said that to be controversial, and
you succeeded. Well done.
And the reason I said that is that people think that Facebook is this unstoppable juggernaut. It's not an unstoppable juggernaut. It's a very powerful company. I think it's the biggest and strongest and best executing company on the web right now. But people want to do more than what they can do on Facebook. They're not going to take over the web. They're not going to take over the world. And what a lot of people like to do on Facebook is go share photos with their friends and talk to their friends. And there's a lot of other things that we can do on the web and will do on the web that we're not going to do on Facebook.
John, I saw you you sort of strained against your collar there at that one moment when Fred said that Facebook was not an unstoppable juggernaut on the web. Do you disagree with that statement?
Well, I'm still trying to get over the view of it being a photo-connected chat site. I think, I agree with Fred. I think they've done an absolutely fantastic job. I think it's my experience with Zynga shows what a powerful platform that is and I think can be. So I think the world's I think Facebook's got very bright prospects, very good people, and I think we're in the very early innings of these social graphs and social networks.
But the problem is only one great company has been built on top of the Facebook platform. That's Zynga. And thank God that Zynga got built on top of the Facebook platform. But what else is there? I just don't see it as a great platform to build a company on top of,
So,
with one exception. I haven't seen. Show me another one.
Got one?
well, we should talk afterwards.
All right.
Okay, so number 3, your friends and your friends at Google, which it's been a long time since Google has released anything that's been truly transformative for the web. The last thing may have been Gmail,
No, but I said other than Android.
other than Android.
But when I said that, I said other than Android.
So where do you think Google is right now in terms of its degree as an innovator, as an ecosystem?
Google is a great acquirer. I think they did a fantastic job with DoubleClick. They did a fantastic job with YouTube. They did a fantastic job with Android. So they have done a better job with acquisitions, strategic acquisitions, than anybody else out there. And so I think we have to give them credit for that. But the last homegrown product that I think is truly transformative that I can think of, and I'm probably wrong about this, is Gmail. And they built that quite a while ago. So I don't know why that is, but it's my observation.
Why is that?
It may not be true.
I don't think it's true. I think there's all kinds of really innovative and essential services that come out of Google that
Like what?
we sort of take for granted. Well, okay, I'll say Google Docs. I think Google Docs is fantastic. It's blowing away an old model for tools for productivity, and they're just way far ahead there.
I agree with that. I think of Gmail, Gcal, and Google Docs as the productivity suite. I think of it all as Gmail.
Take Google Voice, you know?
They bought that too, didn't they? They bought, what's it called? Grand Central.
Sure, they bought Grand Central, and people from Grand Central worked on this, but there was a couple of years of development between the purchase of Grand Central and what came out as Google Voice.
I feel like they bought Google
Right?
Maps, they bought Google Voice, they bought Android. I know, John, I don't mean to be critical of Google because I think they're a fantastic company, but
Here we go. Let's get.
but I feel like they haven't home built from the ground up anything interesting in half a decade.
Is there a difference between hiring an engineer and saying, home build this, or hiring a group of engineers with cash or stock and saying, take what you know and go build this?
Yeah, it's the idea. It's the initial kernel of the idea. I mean, what has Facebook invented recently? Not the status update, not the check-in, not the question and answer site. They haven't done any of that either. They just copied it. Okay?
I feel we're worshiping at the temple of ideas. And I love innovation. I'm a junkie for it. Let me tell you, ideas are easy. There's plenty of ideas out there. What's really dear is execution. It's executing. Facebook really executes. Google really executes. Apple executes. Amazon executes. Ideas are easy. Execution's everything. And you know what? If you're going to execute, you can't do it as a solo programmer. You need a team. It takes a team to win. Ideas easy. Execution everything. Team to win.
So,
Colin, I'm going to close on this. Colin Powell said innovation without execution is a hallucination.
is
A hallucination.
hallucination.
Yeah.
Is that it? All right, just checking. I just don't want to cut you off. So, but speaking of great ideas and some execution challenges, let's talk about one of Fred's companies, Twitter. So, what do you think about that company, John?
I think Twitter is an incredibly powerful information network, not a social network. It's a broadcast phenomenon. Last time I checked, in the last 60 days, they added 30 million new users. The last time I checked in on Twitter, it was not down, it was up. So there's something special going on there. What do you think about that answer, John?
I absolutely agree. Absolutely agree. But it's a great Silicon Valley company that Fred saw from New York. How did you miss that one?
We turned down Twitter when it had no traction and the idea wasn't clear, and we were wrong. I submit with all honesty, humility, we got that one wrong, but we couldn't tell.
John, I think you should go a little easy.
Yep.
He's the Michael Jordan of the venture capital business. Okay.
That's nice.
No, hang on a second.
That's nice. I agree.
All right.
I actually wanted to close before we took a couple questions for the audience. I wanted to let you guys both say something nice about each other. That was actually your chance right there. You just
I blew it?
Yeah, you sort of blew it. I was going to ask you, as a small a puppy in the business, watching and admiring the great John Doerr from afar, what you'd learned from watching him as an investor over the years, and how did it inform your approach to the business?
Don't answer that question. Talk about Bing, maybe.
All right.
Yeah.
I'm not going to answer that question.
All right. Well, the Michael Jordan thing is good.
I will say, what John has done is he has surrounded himself consistently over the years with amazingly talented people. Vinod was on the stage up here. I think that run that Kleiner had from the mid-'80s to the end of the '90s is the greatest run ever. Better than the run the Chicago Bulls had, and I'll stop with the basketball analogies now. Bing Gordon, who I've had the pleasure of working with at Zynga, is an incredibly talented guy. And so I think that's, as great of an investor as John is, I think the other thing that's amazing about their firm and their partnership is the quality of the people that they have there.
Can I go ahead and make the announcement?
Yes.
Yeah, okay. So Union Square Ventures and Kleiner, Perkins, Caufield, and Byers have merged. You've heard it here first. And Fred is leading the East Coast operation of the combined firm. And we have acquired this conference from John Patel.
And you work for us now.
like a dream come true. The funny thing is that there will be someone out here who will actually report that on a blog as true. And it'll be in the New York Times tomorrow, I swear to God, because they have no sense of humor. So we're going to take questions now from the audience. If anybody has some, come to the mics and let's go forward.
First of all, big fan of all three of you, so this is a fantastic session. Thanks. Question, because there's a lot of people watching remotely, and what I'm wondering is, beyond New York and beyond Silicon Valley, can you name some other markets domestically and even internationally that you think are hot for innovation and disruption and whatever verticals or industries those might be now?
So we invested in a company called Shazam in the UK, and it's one of the most downloaded and most used applications on mobile devices, the iPhone, Android, other cell phones. Look at where Skype got started. This innovation is no longer the province of within 20 miles of where we're sitting. It can be everywhere, and there's a lot of it. But I agree with Fred. I think there's an incredible opportunity in and around New York to build new media and new services on top of these two new platforms, mobile and social, coming together.
Well, the only thing I would add is we've made 7 investments in Europe in the past year and a half, and that's about equal to the number of investments we've made here in the Bay Area. We think there's a ton of interesting stuff going on in Europe. I think there's probably equally interesting stuff going on in Asia and India. We can't service those deals from New York, so we don't try. But the only thing that I would disagree with that John said earlier was that these platforms are here in the Bay Area, so you need to be in the Bay Area to access them. And that's not really true, because Facebook's got an API, Facebook has Facebook Connect, Twitter has an API, Android's an open platform, you can build on that. There's an SDK for the iPhone. Katerina Fake wrote a great blog post about 3 years ago and basically said API is the new biz dev. And the reality is, when you got open platforms, you don't need to be anywhere. You don't need to go ask Apple's permission to build on top of their platform. You need to ask the permission to run the app on the platform, but usually that's given. But you don't really, I don't think you need to be here to get those business deals done.
Fred's right that you don't have to be here. But I want to tell you, I think it's a compelling advantage to be able to walk over to Google's Android Developer Center or Apple's Development Center and have them do UI review on your application and be able to recruit out of these places. We've invested a lot, as it turns out, in India and backed 6 consumer internet companies there with Ram Shriram. They're all doing incredibly well. Immobit now is placing more ads and has higher revenue than AdBomb was than it was being bought. So I guess what I'd add is don't overlook Asia. I'm agreeing with Fred on that.
Yes, sir.
Thank you. You spoke about the valuation bubble in the seed world. Maybe comment about the valuation bubble in these later stage venture companies. Is Facebook really worth 35 billion today? Is Zynga worth 6-7 billion today? Is it a supply-demand phenomena as far as where these things are bid? And is this, because venture at the end of the day, it's all about returns and realized returns that'll feed more money in. So, is there some concern with those companies and the valuations ahead of where they really should be in a normal market?
You want to take it? You want me to take it? By the way, I read that Facebook was worth 41 billion. These prices are being generated in the secondary markets. There's a limited amount of supply of stock. There's more interest in the stock than there is supply. So, I think these valuations are, not necessarily, really rock solid. If a company gets bought for cash, then I think you can say that's a bona fide valuation. And if a financing happens, led by a real institutional investor, then I think that you can put some credence behind those valuations. But I think what you're seeing is generally investors believe what John said earlier, is that we're at an inflection point here, there's some big new companies that are going to get created, and that they want to be in these companies, and there aren't that many of them, and so the prices are getting bid up. So I think the valuations are real, as much as they can be.
What I'd add to what Fred said is I turned to Mary Meeker, a longtime friend, and I think the best of how these are going to be valued, either in an acquisition or in a public market. And remember what she said earlier, I think it was today, these are monster markets. She has a better track record at picking 10 baggers, and I mean 10 times appreciation after companies are public than anybody in the world. And I think she would tell us to invest a lot of money in a Twitter or a Facebook at valuations around the ones that are in these secondary markets today.
Okay. We have time for one more if anybody has one. And if not, we'll announce that we're done, and I just need to know where to report for my paycheck from now on. Thank you very much for
Thank you,
for
John.
doing this.
John, you did a great job.
We're going to let you fly business.